Welcome to BMGT 443 Equity Analysis. My name is Joe Perfetti. I will be our instructor for the semester. So we have a lot to cover today, so we're just going to kind of jump right in. I've been teaching this class now for 7 years. Basically, I have 4 undergraduate sections in the fall and in the spring, about 160 students each, and I'm going to be teaching an online MBA version of this class that starts in February. So those are the 4 sections. They run on Mondays and Wednesdays consecutively. So there's an 11 o'clock, a 12:30, a 2 p.m., and a 3:30. So a couple things. One, for attendance, if you need to go to another session and jump to a different session during the week, that's perfectly fine, with a couple of exceptions for exams and presentations, but the rest of the time you can jump around sections if necessary. The other thing I would just say is that I'm only on campus on Monday and Wednesday. This is actually my part-time job, even though I am teaching 9 classes over the 2 semesters. So on Tuesday, Thursday, Friday, I'm off doing work with real companies. And I do a lot of international travel. And occasionally we'll have to cancel a class, which will then become a webinar and or an online video that you'll watch in lieu of a class. So we've also tried to blend and flip some of the classroom. So with that in mind, that's my contact information. That's my Smith email. That's my iPhone, cell phone address. So generally reachable anywhere in the world. Text message can be pretty quickly. I don't really have office hours per se because I'm just here on Mondays and Wednesdays. So you're going to primarily be relying on those 3 TAs. So this class has 3 TAs. Here's your advantage. All 3 of them have taken the class before. And 2 of them, both Ray and Mahir, took it in the fall. All right, so they're very familiar with exactly what you're about to go through. It could be helpful not only in kind of tutoring you, but giving you the lay of the land for assignments. Also, the TAs do all the grading. So they will be heavily involved this semester. And so if you have any issues, talk to them about your grades, etc. They have office hours in my office. So you'll rarely see me in my office, which is 4468 in the finance department upstairs in the corner, but they also will have keys to the office, and that's where they'll be holding the office hours on Wednesdays and Thursdays. Okay. So in terms of the class itself, basically what 90% of this class is about is called equity analysis, picking and selecting individual stocks and analyzing them as would a sell-side analyst, and to some degree writing the valuation research reports. Okay. That's really what you're going to be learning how to do this semester. Very real-world company. 10% of this class is business ethics, right? And it's random, and we understand this. So Smith was going through its accreditation for AACSB, and they pointed out that they needed, all the schools in particular had to up their ethics teachings and particularly measure that ethics were being taught and students were actually practicing good practices. So this class was assigned, my perspective, more randomly, but essentially business ethics as well. So that basically means there will be 2 assignments coming up in 2 weeks that you will have to do to basically show that you are an ethical person. And it will be graded and it will be recorded and sent to the ethics governing bodies. So that's the other thing that got appended on to this class. So we're also business ethics. And then a couple more things. Generally, when we have class, I will try to, as I'm doing right now, record them and post the class videos on YouTube for future reference. Okay. I initially did that when I was missing classes, but people started asking me to do it regardless because it's good reference. So there's already on the YouTube channel, and that's a direct link to the YouTube channel, there's about 140 videos already there. But as we go through the semester, I'll also put the links directly to the classes on ELMS. So you can see that right on the homepage of ELMS, including the video that's being done in the class today. So in terms of the materials for the class, it's going to involve 2 things. One is the textbook. You'll need version 6. You do need the 6th edition of the McKinsey Valuation book. Any of these 6th editions will do. University, Kindle, hardcover, softcover, basically all the same. But you do need a 6th edition. So that is our textbook, and I'm assuming that you're going to be reading it. The assignments are posted on the syllabus. The other thing you'll have to do is about 1/3 of your grade this semester is going to be done as 2 group-based projects, right? So what I've started to do is you're not going to choose your groups. I'm going to choose them for you because I found out that letting you choose your own self-selected groups actually has a lot of problems. So you're just going to be randomly assigned 2 teams. get to know and work with those teams very well because they're going to be responsible for a third of your grade. And 2 of the projects are going to be this. The first one is called Stock Track. Right? Stock Track is one of the most exciting things about the class and something that some of you will end the semester hating me for. So I'll just give you the words up front. So the idea of Stock Track is you will sign up as a team. So once your team is formed, one of your team members will click on the Stock Track link, and you need to click on that specific link in the syllabus because it's tied to this class. They will then ask for a credit card, $31.95. One of your team members will pay it. Everybody else reimburse them. So there'll be about 7 people on a team. So it's going to cost you about $4 or $5 each. And the idea is that you'll get a Stock Track account. Stock Track will give you a portfolio of $1 million hypothetical dollars. And then what you're going to do is over the semester, you and the other 6 teams in your section are going to be competing for who can actually accumulate the highest portfolio value at the end of the semester. Grading is simple. The team with the highest portfolio value gets an A. The team with the lowest portfolio value gets an F. And that's the way the assignment works. It's just pure competition. And whether you win by $1 or $100,000 doesn't matter. It's just pure selection in the real world. Now, I always look at it as a positive because in the real world, if you worked for Fidelity and you were a fund manager and you finished near the bottom, they fire you. So this, to me, doesn't seem like a bad penalty to give you an F on an assignment. But nonetheless, it is 10% of your semester grade. So basically, it's going to be broken into 2 parts. So in about 5 weeks, on the dates on the syllabus from the time we start, we're going to rank everybody 1 to 7, and then I'm going to hand out the grades. And the way it'll work is the team that's in first place gets 5 points. The team that's in second place will get 4 points. The team that's in third place will get 3 points, then 2 points, then 1 point. Okay, so that's how the grading will work. And so we'll do it halfway through the semester, and then at the end of the semester, same thing. 5, 4, 3, 2, 1, depending on where you place in the classroom. That will add up to 10% of your semester grade. It's, again, purely performance driven. Now, there's a couple things about Stock Track that I did disable because it's actually a trading platform. Now, it's hypothetical money, but you can do just about anything you can in the real world. It's kind of a fun exercise. But primarily what you're going to be working on is you can only do equities. I've eliminated the option for day trading. And you can't put more than 20% of your portfolio into any one company, so you got to diversify. And you must make a minimum of 10 trades each part of the semester. You can't leave your money in cash. Okay? And again, it's just relative performance of the teams. What it will force you to do is pay attention to the real world. So for example, Sprint just invested in who, causing their stock price to change by how much? Wasn't SoftBank. Tidal. Why did they buy Tidal? Who said Tidal? Why did they buy Tidal?
I don't know exactly.
All right, so gold star for identifying Tidal. So that's the point. We need to be paying attention to, this is a real world class, so what's some of the things that are going on in the real world, because a lot of your assignments are going to come from things that are happening in the real world, just so you know. But nonetheless, their investment in Tidal helped actually their value, their stock price. One of the reasons is competitive. T-Mobile started it with, all you can eat stream video. AT&T's now doing it. Sprint did it defensively. But here's another key point. By 2023, streaming will represent $20 billion a year of revenue. It's actually going to be giant for the music industry, and the music industry is a huge supporter of this. So on the one hand, Sprint's doing it defensively. On the other hand, they just bought their way as a joint venture to some degree into a very rapidly growing marketplace. And so that's what I mean by we have to understand this and the financial implications on a company's stock when these transactions are made. Doing Stock Track will help you start to pay attention to this in the real world. Okay. The other group project that you'll be doing is a group valuation project. Second half of the semester, I will assign an industry. Let's say I said telecommunications or internet service providers. So your company might be Comcast. And so basically you'll do a valuation, buy, sell, hold opinion, target stock price, recommendation, financial analysis, industry analysis of Comcast and their prospects. That will be done as a team. Final week of class, you'll make a presentation to me, basically telling me what's going on. And so basically I'll choose an industry. You'll all have companies, different companies within the industry. And so we'll have 28 group projects across the 7 sections that will be presented the final week of class. So applying what we have done. So those are the 2 group projects that you're going to be focused on this semester. Grading is going to be broken up on a 100-point scale. What's important to understand about grading in this class is the grade on any individual assignment is irrelevant. You are accumulating points towards a final grade for the semester. Grading is based on 100 points. So to get an A- in this class, you need 90 points. So the grade on any assignment doesn't matter. You're just trying to accumulate 100 potential points, right? So 90 is an A-, 93 is an A. A+ because of extra credit will actually vary. Last semester I ended up giving 5 points of extra credit potential. So there's some possibilities for extra credit if you don't do so well. Make up for things like not doing well in stock track, but etc. So 30% or 30 of the points are homework and in-class assignments, of which there will be 11 of them, 11 homework assignments plus in-class assignments. There will be a 2-part midterm exam, which will take an entire week. 10% of your semester grade, 10 points, is stock track. Best you can do is 10, worst you can do is 2 points. The group valuation project is 25% of your grade, and there will be a final exam as a take-home the final day of class, which will be 20% of your final grade. So in terms of attendance, generally a lot of these classes are going to be on video, and by halfway through the semester, my guess is we'll probably see about half this room empty, right? Because you'll quickly find that you can watch the materials online unless there are technical difficulties, with the following exceptions. There are some classes which will be required mandatory attendance, right? And I'll tell you about at least 2 of them. So for those classes, you have to be here. And I would encourage you to be here, but you're adults. And as I said, there's some ability to take some of the class virtually, so it's up to you as long as you can get the assignments done. So if you miss those mandatory classes, you lose 5 points per class missed towards your semester grade. So those are very, very important to be here for. And I'll talk about those in a minute. Also, don't violate the honor code. There were some allegations of honor code violation last semester, and it was just bad for everybody. And it's ironic that we're now teaching a class on business ethics, and they still violated the honor code, but that's okay. Just don't violate the honor code. We don't want to go there. In terms of the late assignment policy, basically, I'm going to treat you like you would be treated in the real world, which basically means if you miss a deadline, it's like the work wasn't done. So you just get a 0, we're not going to grade it, and we're going to be pretty hard about that penalty. So missing deadlines, you just don't get grades. You don't have to worry about making up the assignment. But here's the thing. If you talk to us before a deadline, we can offer you some flexibility. So just remember, we are flexible, and I say we because I've delegated some authority to the TAs as well. They've been through the class. They kind of know how I make decisions. But if you talk to myself or one of the TAs, and the best way to do it is in writing. We need a record of it as an email, okay? So otherwise, verbal conversations can't be confirmed. So email before a class or before an assignment is due. We will generally try and be flexible. Afterwards, we will be unsympathetic. So just if you need an accommodation, talk to us. I'll give you an example. So today I had outpatient surgery, and I know how hard it is to get, an internist to do a surgical procedure in their office. So I had to schedule this pretty far in advance, and they didn't give me a lot of options of what I could do. So, unfortunately I had to move the first class and record it accordingly. So I understand flexibility. There's things you got to do. I have a guy in my online MBA that's on the lacrosse team, and basically he's traveling with a lacrosse team, so he's going to have to miss a couple of classes, and we're going to arrange some things. We talked about it. We're going to do it. Happy to do it. So again, got an interview, understand, you got to go to New York, it's very important to your job. We'll make an accommodation on the assignment, show us, what the interview date is. But don't tell me that I didn't do the assignment because I went on the interview 3 days later, because then I'll say, I hope you did well in the interview, but you won't get credit for the assignment and no ability to make it up. All right. Now, university-approved excuses like, sickness, death, and family, obviously, if it's a real emergency, we'll definitely accommodate that. But just be an adult about it, and we'll definitely try and help you in advance. All right. So, a couple more things. Bloomberg. The most important thing I can say today is this is a class that will heavily rely on Bloomberg Professional. You are in a room in a special place. The University of Maryland, College Park, is the #1 user of Bloomberg in higher education in the world because of this class. Put this into perspective. I went to Wharton. I go to Wharton all the time. I still do some teaching at Wharton. Wharton has 2 terminals for their entire MBA student population. 2. We have 60 terminals at College Park. There is no other university in the world that has as many terminals. There's no other university that has a lab like this with just 25 terminals that a class is taught in. And Bloomberg's very proud of us. They give us a lot of support. You should understand the value of what you are getting to actually be able to use. Bloomberg Professional is the standard that is used in the financial community. You work at JP Morgan, this is the software that's on your desk. It's very expensive software. It costs approximately $22,000 per user per year, minimum 2-year subscription, right? And that's for the base model without any additions, which they charge more for. So basically you're using the equivalent of $44,000 worth of software that you get for the price of free by being at this campus in this class. So my hat's off to Dean Trianis, because he has protected this through budget cuts, and the university with a discount still spends $300,000 a year, so you have access to this in this lab. So very, very expensive, but very real world software. And here's the thing. How many of you have used Bloomberg before? About 4 or 5 of you. Here's the good news. In a week and a half, all 40 of you will be Bloomberg certified. So one of the other requirements, and it is 5% of your grade, is to become Bloomberg certified. And so by the end of the semester, you're going to know Bloomberg pretty well, right? Matter of fact, you're also going to know Excel pretty well. So those are the 2 software programs we're going to be spending a lot of time on this semester. So first thing you're going to need is you're going to need a Bloomberg account, and you're going to have to basically start doing assignments in Bloomberg. Part of the reason for certification is a lot of the assignments will require using the terminals, right? So I'm not going to spend a lot of time on this because I think you can read, but a couple of key things that are coming up on the syllabus in terms of the outline. You can see when assignments are due, when readings are due. Generally, you should assume that most, with a couple exceptions, assignments will be due on Mondays. So they'll be handed out on Wednesday electronically at Elms. They'll generally be due on Monday, with the exception of next week's assignment, which is actually going to be due on Wednesday, because I'll hand it out on Monday. So today was the first day of class. So the idea is today you should start signing up for a Bloomberg account. It takes 3 minutes. I'm going to walk you through that in just a couple minutes. In addition, next week we'll do EIC, and groups will be formed by next Wednesday towards the end of the drop ad period, because I assume we might have some shuffling. So the groups will be assigned to you and know who's in your group next week. The week after next, week of February 6th and 8th, there will be no lecture. And what I'm going to do is I'm going to give you both class periods to do 2 things. One, complete the Bloomberg certification. Because in order to become Bloomberg certified, you will have to do it through the terminal. There are 40 people in the room, there's 25 terminals. So not everybody could be on the terminal at the same time. It will take you approximately 3 or 4 hours to do the certification self-paced. Okay? And there's a test. And you must pass the test and get 70% of the multiple choice questions right. Otherwise, you won't be considered certified. Okay? So what will happen, and we'll go more through this on Monday, is that there's a code that Bloomberg created for this class. In the terminal, when you go to BMC, Bloomberg Market Concepts, type that in. You'll basically type in this code that will associate with you with this class, so Bloomberg can send me a report of who did the work, and they'll send me your score on the multiple choice test. So there are 4 modules in Bloomberg Market Concepts. Economic is 1, equity is 2. Those are the 2 modules that you have to complete for certification. Again, about an hour and a half each. If you actually take the time, watch the videos, answer the questions. All right? That's all you have to do for the class. Complete those 2 modules, answer the multiple choice questions, get more than 70% right, submit that you did it. That's your Bloomberg certification. So I'm giving you class time that week to do it. Okay? Now, obviously, you can do it beyond class because it will take more time, but the labs are going to be clogged, and you need to do it for future assignments. All right? The other thing, just to let you know, there are 2 additional modules that are optional. One is on fixed income bonds. The other is on currency, and those are at your own behest. Now, Bloomberg will not give you a certification and a certificate unless you complete all 4. Okay, so you won't get a certificate of completion by Bloomberg unless you do all 4. But I'm only requiring 2 of the 4 for this class, what I will call your certification. So you'll be certified in equity and economics, but you're not getting a certificate to put on your resume from Bloomberg unless you do fixed income and currencies. That's extra. I'm not tracking it, but they will give you a PDF if you did all 4. And again, same thing. You just do the multiple choice. You get more than 70% right. They give you a PDF file, and then they'll mark it on your account. Yes, sir?
If we already have a certificate, should we still do it again, or?
How long ago did you do it?
Last semester.
Then yes, I'll accept it. If you can get proof that you've done it, then I'll accept it.
Okay.
I only say that because they actually redesigned it last year.
Okay.
So the new BMC, yeah.
Does it all have to be done at once, or can you do it?
No, it'll pick up where you left off.
Okay.
So you can go back multiple times. Yes.
You said we get graded for getting it. Is that based on just getting it done?
You get it done, complete more than 70% correct, you get 5% of your semester grade. Done. Because the point of all of this, and the reason why I'm putting a high premium on finishing it, is because every assignment thereafter, almost every class thereafter, will be living in Bloomberg. So if you're not certified, you'll have no idea how to do the assignments, and you'll be completely lost in what we do. And to be honest with you, it'll be a tragedy because there is so much value that you're going to get out of this thing that you're really missing an opportunity here, particularly as finance and accounting majors. So that being said, the other thing that's going to happen the week of the 6th and 8th is I'm going to make that the ethics weeks. So that week, you're going to have to also do the online self-certify for the ethics. Similar thing, except you go to a website, you again watch the website videos, you read the content, you answer some questions. And there will be an ethics paper, which will be due the following week, but nonetheless, there's some ethics stuff you'll be doing that week. The other thing I want to say is February 13th will be an important class because that will be the most academically difficult class of the semester. It's on reorganizing financial statements. You may have heard in the past from former students, there's a very specific approach to financial statement analysis we use in this class from McKinsey, the consulting firm. And so basically we reorganize the gap statements into this format to do valuations based on Modigliani Miller and to do an analytics. So I'm going to teach you that reorganization process. It's something you've never seen before, and people struggle with it just because it's different. So that's going to be the week of February 13th and the week of February 20th. It's going to be introduced the 13th. So generally, I would say it's easier if you're here for that. But again, just giving you a heads up, it's not mandatory. Right? So those 2 weeks, we'll be doing financial statement analysis. Week of the 27th, we'll do multiples. Week of March 6th, we will start in Excel building the valuation model. Okay, so that week, everyone will need a laptop. There's not enough computers in the room, and frankly, they're 9 years old and crash all the time. So basically, I'd recommend bringing your laptop regardless. But you're going to need Excel. And we're going to build a valuation model over that 2 week period of time, a real world valuation model. In fact, I just got an email the other day from a former student who works in an investment bank who asked for the most recent class model. These are still used in the real world, and I use them myself. So you're going to build it. I'm going to build it with you. Here's the thing. It's going to take 2 weeks to build the first model. It'll take 10 minutes to use it on another company. So we're building a reusable model that's tied to Bloomberg with almost real-world fill-in of the data. So it's basically a reusable model. So long story short, we're going to be doing that. And then the week of the 13th will be the 2-part midterm exam. I'm hopeful that that will just be a take-home exam, so it won't be class. You'll just take the 2-part midterm. But it's a 3-hour midterm, 90 minutes each day. Right? And then you'll have spring break. When you come back from spring break, we'll finish up the valuation model, doing it on a real-world company. And then the month of April, by the end of March, we're done with the academic content. And the month of April is all real-world. So, and again, I'll rip from the headlines. Hey, let's look at Sprint. Let's look at the acquisition and title. Let's look at the change in the cash flows. Let's look at the value. Let's figure out a buy, sell, hold, target recommendations, what the optionality is on the bull bear of their stock price. Like, that's the reason why there's nothing listed for case studies there. So the case studies here are literally what's in the headlines that week. All right, so we're always going to be applying what we do to the real world. Simultaneously, the month of April, as we covered all the content, is when you're going to be in your groups. I'm going to assign you the industry and a company, and you're going to pick a company, and you're going to do your real-world valuation project over that 3 weeks as well, presenting the week of May 8th. So again, May 8th, May 10th, mandatory attendance, whether you're whether you're presenting or not, must be here for those dates. Otherwise, that's the 10% grade penalty that I talked about. So very important to be there, unless there's a very specific reason not to be in advance. May 10th, our last class, take-home final exam. All right, so today we are going to go through a lecture, start lecture note 1. But before we do, I also wanted to talk a little bit more about your Bloomberg account registration. So this is a login for Bloomberg. So on the computer desktops, and it was reported to me by the last class that 5 of the workstations are broken, okay, because these computers are 9 years old. So generally, if you find a broken machine, alert me. I'm going to try and tell IT, and hopefully they said they'll get it fixed by Monday. But generally, these computers, it's ironic that we spend $300,000 in software on 9-year-old computers that barely work and die all the time. But regardless, that's just the way the budgetary system works. So again, if they're fixed, let me know. I'll try and let IT know. So there should be an icon. It says Bloomberg, because it's just software, on the desktop. Click on Bloomberg, should launch into something like this. Now, Bloomberg is Michael Bloomberg's company, former mayor of New York. He started the terminal back in the 80s, so it was originally a DOS-based, text-based, and keyboard-based system. And even though today we're in the 21st century with graphical user interfaces, Bloomberg still is very keyboard-based because there's a lot of people on Wall Street that are used to the keyboards. So, nonetheless, you're going to see the power of the system regardless of the interface. Very powerful system. So, select your language, click Enter, which is the Go key, or Go or Enter the same key. And then if you have a username and password, you type it in. If not, you'll have to create an account. Now, here's the thing about the software. You can actually go to Bloomberg.com, across the top menu, download the software and install it on any computer. However, you'll see on the screen there's a serial number and a terminal ID. You won't have those when you download it on your laptop or home computer. When you then download it and install it, it's going to ask you to call customer service. They're going to ask you for $44,000. So you're not going to be able to use the software outside this lab, because even though you can download the software without a serial number tied to a very specific computer ID, it won't let you in. Now, the advantage of this lab and the other labs on campus, including the one downstairs, is there's 25 terminals here and 25 terminals there. We got 50 terminals in the labs. And the way it works is those labs are under open license, which means anybody that uses the terminal in that lab is assumed to be faculty, student, or staff. And Bloomberg doesn't check your student ID. It just lets you log in if you're in the login, and it will give you a free account. Okay? And as long as you log in every 30 days, it'll keep the account active. They don't even know if you graduated or are a student. So you can just keep using this. As a matter of fact, one of my TAs just graduated. He doesn't start his job at JP Morgan until the summer. He's like, can I come back and use the labs? Sure. You know, as long as you're using it on campus, then there's not going to be a check of your actual student class, because they're assuming that you were a student or a faculty staff of the University of Maryland. So back to this. So here's the thing. If you get an account and you go to JP Morgan, your account won't work, right? Because your accounts are tied to these 60 terminals, right? So the 60 terminals are open to the community and anybody can sign up for one, but you can only use it on these 60 terminals. It won't work on other Bloomberg terminals, with one exception, all right? So be quiet about this, even though this is on YouTube. So, because the other faculty hate me for this. But 59 terminals are that. One terminal is called Bloomberg Anywhere. I happen to have it. And what it does do is it requires fingerprint authentication. It's tied to me, and I can use it anywhere in the world, right? And that's primarily because I will be. Like, I'll be in Shanghai doing a webinar with you guys for this class. So basically, I travel a lot, real world stuff. So they made an exception. They gave me this, but it requires my fingerprint every time I log in. So I can't give you my username and password. You'd still have to have a fingerprint reader in order to do this. So here's the point. Without that, you'd have to use one of the terminals. So your certification, you're going to have to do in the lab. Now here's the thing. Down here at the bottom, create a new login. It will then ask you a series of questions. Are you creating this for somebody else? No. It's like a trick question. You're creating it for yourself. Have you ever been a Bloomberg user before? If you say yes, it's going to look up your old account. If it's inactive, then you'll go through a series to try and reactivate it, re-give you a new password. Right? For the vast majority of you, no. And if you had one before, I'd probably recommend create a new one unless you're really using it. So, are you been a user? No. Next. Then type in your name, pick a login. It'll warn you if that login exists, so you probably have to create some crazy name. But then, this is key, put in your cell phone, an email address, it doesn't have to be UMD, any email address. And when you hit next, what it's going to do is it's going to send a code to either that cell phone, call your cell phone, or email you the code, which you'll then type in to confirm it's you, and then the account will be created, and then you'll have the ability to choose a password. Okay? And then the account's done. So it's a process. It should take about 3 minutes. I'd encourage you to do it right now, and even while you're sharing the terminals. So go ahead and get the accounts loaded, see if there's any problems. Yes, sir? Any of the computers should work in this room. What computer number is it? There should be a number across the top, taped on the monitor. We'll figure it out. I'll add it to the list for IT if it's not already on there. Because we got five machines are already broken. We identified that earlier today.
17 just doesn't.
Yeah, that's broken.
16.
I think that's on my list. 16, 17, 25, and how much? 23 is broken too?
Well, if the light's not purple, the screen won't turn on.
What's wrong with it?
The screen won't turn on, like the light.
Won't turn on?
Yeah, like it's just black.
Okay, so 23, no screen.
Yeah, it's probably mine also.
All right. And which one was that again?
16.
16. We already got that one flagged. Yeah. 28 too. Screen? Yep.
So there's an error.
There's the error blue screen to death.
No, it just.
What? What number is that? 14. Try rebooting that one. That might actually work. So, again, I have an account. I'll type in my account. Type in my password. Now, the one difference is I will have this little flashy thing. You won't see this, but I'll have to swipe my fingerprint, hold it to the flashy thing with the fingerprint reader. It'll give me a 4-digit code, and I have to type that in addition to the password. That's their copy protection. All right. So this is the terminal. Well, some of you are registering. I just want to give you a real-world exercise of how we do it. Over the next 2 weeks, I'll give you a more formal tutorial of how to use Bloomberg. And you're going to be going through the certification. All right, so I'm going through this one very quickly. But here's the thing. By May 8th, May 5th, whenever our presentations are, this will be you. Okay? So here's an example. On the equity side, there are 847,000 companies in the database. All right? You get almost real-time data for any one of them, publicly traded anywhere in the world. So here's a real-world story. So there's a company called Merck. So you can type in ticker symbol, MRK, U.S. equity. In fact, I'll be working with Merck next Thursday. That's a real-time stock price for Merck. And if I type GP, which is graph their stock price, this is 1 year of stock price. I click here. This is 5 years of their stock price as of today. And one of the things you'll quickly notice is the stock price has been pretty flat over the 5 years, right? With the exception they had a little bit of a bump up there. If we want to figure out what that bump up is, we can click on chart content. Sorry. We can click on news. I don't know why it's not working for me. And it should overlay, there it is, key events. There you go. We can click on key events, and it will overlay key events that happened at various points, whether it's insider selling of stock, whether it's important news items, whether it's upgrades or downgrades by analysts. So we can also start getting understanding of what might also be one of the catalysts that could quickly cause the change in the stock price, right? So here's the point, though. I happen to know what happened here. So Merck stock price is relatively flat. So one of the things is I can look at what's called total shareholder return, which COMP will then give me total shareholder return for 5 years. And if you look at this, as of today, 5 years ago, you bought Merck, you averaged a 13.16% annualized rate of return. If you bought the S&P 500 index on the same day, you made 14.62% compound annual growth. If you bought a healthcare index of other big pharmas, you made 16.77%. So one thing we can quickly see is Merck has underperformed not only its peers, it's underperformed the market over the 5 years. So even though 13% sounds pretty good, it's actually not that great. So why? Intrinsic value. Company's worth the sum of its future cash flows. ROIC, key topic you're going to read about the book, is predictor of what those free cash flows are going to be. RV. Used to be called relative valuation. This allows me to quickly compare Merck against competitors. I have this comp source, GICS, Global Industry Classification Service. And I'm going to use country of domicile. So therefore, U.S. competitors that have been classified as Merck's competitors. So Bloomberg has all these predefined templates, but I can come over here and we're going to learn the certification. You can create a custom template. Add column, ROIC, return on invested capital. It's a standard term in Bloomberg. As of the latest filing, that is the ROIC for all of the firms on that list. So the industry weighted average is 9.63%. Merck's is 8.2. Then I type in WACC, weighted average cost of capital. Bloomberg calculates a real-time WACC. 7.74% for Merck, 7.5% for the industry. So one of the reasons why Merck stock price hasn't been going up is ROIC is like a one-period IRR, and when your cost of capital is pretty close to your R, you're almost breaking even on a value standpoint, and that's the point. Merck is a close to zero NPV company, and that's why their stock price isn't going up. And very quickly, that's the insight that you're going to have in this class. Unless they do something differently, stock price isn't going to change. But within the period of the year, some things have started to change. So, company called Bristol Myers, right? And Merck and Bristol Myers are both competitors in oncology, which is cancer. And Bristol Myers and Merck both have an immunotherapy drug, which is revolutionizing medicine, healthcare, and making them a lot of money. And Bristol Myers' drug is called Opdivo, and Merck's drug is called Keytruda, right? So the idea is if you have cancer, you can have chemo or you have radiation. Both are bad for you. But these drugs will actually use your own immune system to attack the cancer, kill the cancer, and cure you. The most high-profile one was Jimmy Carter, former U.S. president. He had stage 4 brain cancer, inoperable. They told him he was going to die. Right? He got into a trial with Bristol Myers Opdivo. He saw the Falcons make it to the Super Bowl last weekend. 100% remission cured him, an inoperable brain tumor, right? Because immunotherapy works. But here's the thing. What they're finding is that immunotherapy only works on about 1 in 3 people. So if you don't have this genetic marker, I think it's called a PD-1, then it's probably not going to work on you. And if you do, it does work. Jimmy Carter happened to be one of the people that had the cancer, that had the marker. It worked on him, cured him. But if you don't have that marker, you're still probably going to die. So here's the thing. Bristol Myers and Merck have been approved for 2. One had neck cancer, it was brain cancer, for 2 indications. But they're applying for like 30 different more. They have clinical trials now. So prostate, breast, different types of lung, pancreatic, whatever. They're trying it on everything. And if it works, this could be a really big deal. So here's the thing. In the New England Journal of Medicine in August, they published the results of clinical trials where Merck and Bristol Myers both did a clinical trial for their immunodrugs. Except they did the clinical trials differently. Bristol Myers chose, a couple years ago, to take everybody. So if you have cancer, you get in for this lung cancer trial. They took everybody for lung cancer, and they basically brought him into the trial. And they said, we're going to see how it goes against chemo and radiation. Then Merck did a trial, but they only took people that had the genetic marker. Because if it didn't have a genetic marker, it probably might not work in the other population. We're not 100% sure, but we're only going to do people that had, they tested for it, and you had to have the marker to get in the Merck trial. So here's what happened. In August, the results came out. Bristol Myers underperformed chemotherapy. You were better off getting chemo than taking Opdivo, right? That was really bad for Bristol Myers, and the FDA looked at the data and unapproved their drug. Merck beat everything by a lot. Merck not only beat chemo, they actually became the first-line treatment for lung cancer. Like, they go to the Merck drug first. By the way, this drug is $110,000 a treatment, a little 2-ounce vial. So, really expensive drug. So, here's the thing. If you look at the number of cancer patients, and you look at the fact that none of them can go to Bristol Myers anymore, and everybody thought that they were going to get the approval, it was unexpected. So here's the thing. ANR, analysts. These are the sell-side analysts that are covering these companies. These are the Merck analysts. And here's the thing. Here are the Bristol Myers analysts. Well, I'll start with Merck. So yesterday, what the hell's this guy's name? Chris Schott of JP Morgan put a buy on them, $68 stock price target. John Boris of SunTrust Robinson Humphreys also is a buy, $73 stock price target, put it on yesterday. So here's the thing. Right now, there are 23 analysts at Wall Street covering Merck. 14 say buy, buys are worth 5 points. 8 say hold, holds are worth 3 points. 1 says sell, sells are worth 1 point. On a 5-point scale, Merck is a 4.13 out of 5. 12-month price target is 68.74. Right now they're trading at 61.15. They got about a 15% upside based on what the analysts are predicting over the next 12 months. Now, each of these analysts, so here's John Boris. This is John. This red dot next to his name basically means that he has, at his Bloomberg terminal, he stepped away and he's offline. When it turns green, he's online. You can IM him. Right? He works for SunTrust Robinson Humphreys. That's his address on Fifth Avenue in New York. That's his phone number. Okay? This is real contact data. You call that number, you IM him, he might actually answer. You tell him a student, he might not return your call. Put that aside, you can get real contact information, their own version of LinkedIn. Look at his bio. There's his picture. There's his education. He went to Columbia for his MBA, Philadelphia Pharmaceuticals as an undergrad or graduate degree. And that's where he works, his work history, etc. But these analysts have a coverage universe, and these are the companies they cover. But what he does more than anything else is he helps create this. This is the consensus estimate database that Wall Street uses to forecast financial information for companies. So when you read whether a company missed or met their expectations in the Financial Times or Wall Street journals, this is where the data is coming from. So, for example, it's done on an annual basis. If I switch to quarterly, when Merck reports its quarterly results, basically this is what's for the fourth quarter. This is what they're expected to report. So when the data comes out, this is what they're benchmarking against. John is putting in his guesses, which are aggregated with the other guesses to create this consensus estimate. Sales, profits, etc. So here's the thing. When an analyst covers a pharma, they don't just forecast the revenue for Merck. They actually forecast the revenue for Merck by drug. So this is every one of Merck's drugs, from Januvia, Janumet to Keytruda to Zepatier. And if I scroll down, drugs that are under development that are in early stages of the pharmaceutical process with a weighted probability of the revenue based on potential approvals. That's what these pharma analysts are doing. It's aggregated to get a revenue forecast for Merck. So here's what happened. Let's go to Bristol Myers. BMY. We go to Bristol Myers, type in stock price, GP, graph price, and what we quickly see over, here's 1 year stock price. When do you think they got the bad news from the FDA that they weren't going to have Opdivo approved? I don't even have to put the overlay of the news to see that it was right here. Because what happened is when people got the news at the Wall Street community, within minutes, they went in and they adjusted their forecast for Bristol Myers' number one drug. This number for 2019 used to be $10 billion in August, because I was tracking this. And now it's $6.4 billion. So they lost over $3 billion of revenue on an annualized basis starting in 2019 because they didn't get approval for lung cancer. Who do you think got that revenue? What do you think happened to their share price on August 6th?
Went up by that amount.
That is August 6th Merck, 10% increase in their share price. How do you know it went up 10%? I can look at the stock price. Why should it go up 10%? I have to quantify $3 billion of sales at Merck. So what the analysts did is they went to Merck and they went to Keytruda, which is their competing drug, and they took Keytruda from a drug by 2019 that was going to be $3 billion in revenue to $6.2 billion in revenue today. So you could literally see in Bloomberg the shift of the analysts moving $3 billion of revenue from Bristol Myers to Merck, figuring out the margins and the cash flows, quantifying what the impacts are going to be, and that's what caused the stock prices to change. And that's why they changed. And this all happened within a matter of minutes. And by the way, the week of May 5th, this is you in front of the classroom explaining this to me on the companies that you're covering. That's what I mean by understanding Bloomberg and using and applying Bloomberg in the classroom. This is not a Harvard Business School case study. You're going to be using real world data on real companies to explain real indications of stock price and expectations. And you're going to understand all the math behind this stuff and the academics. That's the semester. Okay? We're working to this. I don't expect you to get there today, right? There's a lot of stuff you got to do before you get there. But number one, you got to get certified. You got to get an account. You got to get certified because there are over 30,000 screens on Bloomberg. As they even say, the average person knows 20. Right? And if you know 10 of them by the end of the semester, you'll look like a pro. And I'll just give you an example. WAC. There is the real-time WAC for Merck. There's their cost of equity based on the current stock price. That cost of equity is using CAPM. That's the current yield on the 10-year treasury. That's the current beta. That's the CAPM in action. That's the yield to maturity on their debt for the cost of debt based on an effective tax rate. All in real time estimating a WAC for Merck. So again, very usable to us versus doing it ourselves by aggregating and collecting the data. So these are the types of things when you get certified, you got to know what you don't know is there so that we can actually then apply the analysis that I showed you. So when I say ROIC against WAC, understand the principle, but Bloomberg will help get us the data to apply that to what we do using the academic formulas. So that's where we're going with this. Does this make sense? Questions behind this? All right, so lecture note 1. This PDF is on Elms in the files folder. So in Elms files for our class, there's 2 files up there right now. There's a folder called lecture notes. As we do lecture notes, I'll post them up there. And there's a section called in the files. There's also on there the syllabus. Plus it's in the syllabus section. All right. So as you do the readings for this week, coming up once you get to the book, 4 cornerstones of value creation. These are the important themes to understand over the course of the next 6 weeks. Okay? And so we're going to be building deeper into these themes. Theme number 1, I've already illustrated to you. Valuation is not about growing EPS. It's about free cash flow. Right? And more specifically, ROIC is a proxy for free cash flow. So therefore, it's spread. You only create value with spread. Spread is based on IRR and NPV. So ROIC, if you think about it conceptually, is like a 1-period IRR. WAC is a 1-period R. The only way you create value, the IRR has got to be greater than R. It plays out in the real world. I just showed it to you in pharma. Okay? So the key is, what is that over time? Challenge Merck has right now, even though they just had a big win with Keytruda, they got a bunch of other drugs that are going up patent they don't have a reply for. So what does that practically mean? It basically means, in a nutshell, that Merck is 0 NPV when you net up all its drugs. And that's why its stock price has been flat for the last 3 years. Okay? And so that's what you're going to quickly understand about companies when you understand what's happening with their stock price. Point number 2, it's about cash flow, not accounting. Right? I know half of you in this room are probably accounting majors. God bless you. But here's the point. Accounting is a predictor of cash. It's not the cash itself. And in our world of finance, timing matters. Discounted cash flow, the discounting, the risk adjustment. So everything we do is going to be on a cash flow basis, not an accounting basis. That's going to, well, I told you, it's the McKinsey approach is to take accounting statements, put them back into a cash flow format. That's why it's going to be hard because we're used to accounting statements, but accounting statements are much less predictive of companies' values than cash flows. So cash flow. 3rd cornerstone, expectations, intrinsic value. Company's worth the sum of its future cash flows. That's why we need a data service like Bloomberg that tells us the expectations of the institutions that are covering and owning these companies to figure out what their expectations are because they are the price setters. So what are the expected cash flows? And I'm telling you, historical analysis will not work for you because it's like driving a car or looking at the rearview mirror. The problem with financial statement analysis is you're looking backwards. And if the road veers, you're going to go flying off that road and you're going to crash. Right? So that's the problem with financial statement analysis. So we have to become predictive of what a company is going to do in the future. So it doesn't hurt to understand what some of those real world predictions are. And I'll give you 2 quick examples. Let me go back to Bloomberg. Example number 1, Tesla. I don't know if he was serious or not. By the time somebody watches the video on this, they'll probably see this. Elon Musk tweeted out this morning that he's going to start tunneling in LA as an alternative form to get faster with traffic. Now, to me, it sounds like a lot of sarcasm. He's probably got pissed off being stuff and tracked it. But when he says stuff like that, and this is the guy that's like sending rockets to Mars, people actually believe him. So nonetheless, he was talking about tunneling. So Tesla is one of his companies. And if you look at Tesla, how is Tesla doing? What do you think? Really good? All right, so let's look at Tesla. Tesla, whose stock price today is $254 a share. If we go to the DES screen, stands for description, summarizes a lot of data. Tesla today is worth almost $41 billion in market cap. Share price times shares outstanding. So when you say very good, they're a $41 billion company. Right? But for the accountants out there, if I type in FA, financial analysis, this gets me to historical financial statements. These are Tesla's historical financials through 2015. 2015, last reported year, they did $4 billion of revenue, up from $111 million. 2015, they lost $900 million. Matter of fact, what you quickly see is the more revenue they generated, the more they've lost. And with these bigger losses, they're worth $40 billion. Well, that doesn't make any sense. How could that be? How do you come up with a valuation of $40 billion when a company has never made money? And the bigger they are, the more they lose. And if your answer is it's new math, then I'm going to put you in the Kellyanne alternative facts category. I'm going to dismiss everything you say this semester, drop the damn class. So it's not new math. Yes?
I was just going to say that there's a lot of stuff that we're playing for the future, that people have a lot of faith in them as a company, have a lot of faith in Elon Musk.
That's right. So they translate that into a future financial forecast. And if you go to EEO, which is the earnings estimates overview, the consensus estimates that I just showed you, then the faith in Elon Musk is by 2019, they're expecting $23 billion in revenue and income of $1 billion on EBITDA of $3.3 billion. Right? That's why Tesla is worth $40 billion. And when you have $3 billion of EBITDA, well, that's basically a multiple of about 13. Right? That's not crazy. It's high, but it's not crazy. And I'm just telling you that that's what you start to need to understand is going on here. Because when people are talking about Tesla, they have no idea if they're not looking at this approach as to why Tesla is being valued at what it is. And this is what you're going to quickly learn this semester. Right? So, by the way, that is also based on a forecast that they are going to sell 340,000 cars. So that's the key, is they're building the Gigafactory in Nevada right now. They're building the ability to launch the $35,000 car. If they can't build it in time and sell this amount of cars, they're not going to get the revenue. They're not going to be worth the price. And so we have to track that if we're tracking Tesla to understand that expectations are key. Just as, I'll go back to pharma for a second, there's a company called Gilead. Gilead basically created a cure for hepatitis C. So apparently I watched the commercials. A lot of people have hepatitis C, have no idea they have it. Gilead's got a cure for it. Right? So they have seen a pretty good 5-year run in their stock price. In the interest of time, if you go to the RV screen, you will see that Gilead's ROIC last year was about 34%. They have an astounding ROIC, and they have patent protection for these drugs that do Hep C. Right? Here's the problem. This is their stock price, your 1-year stock price. If you bought based on that information back last year in April, you lost 40% of the company's share price, given the fact that they have a monopoly and a great return. Why? What do you think this is predictive of by the markets? Why is their stock price going down? What must be happening? And think what we just said about Tesla. What's going on with Gilead?
They're not meeting expectations.
That's right. The expectations are what? Better or worse for the future?
Worse.
They got to be much worse. So that's the point. If I look at their current financials, it tells a great story. But the market's not valuing them on that. They're valuing on obviously something that's worse, which is why their stock price is plummeting in the marketplace. So here's what the analysts are saying. This is the analyst expectations for earnings for Gilead. If I look at the pharmaceutical drugs, the top 3 drugs for Gilead this year, HCV, Harvoni, and Sovaldi, represent 15, 9, and 4. So let's just call that $28 billion worth of revenue. Okay, rounding off. By 2019, 10, 4, 600 million. Let's call that 14 billion. They're going to lose for their top 3 drugs 50% of revenue in the next 3 years because this looks like a drug that has a patent expiration and this is a drug that has biosimilar competition. That's why their stock price is plummeting. And when you look at their pipeline, there is nothing in their pipeline that looks like it's an impending blockbuster. Like here's a drug that could be $1 billion a year in 3 years, but there's nothing that's going to replace the $14 billion of revenue that's evaporating. That's why now's a bad time to buy Gilead, right? Because you look at their numbers and you're like, what a great company, but they have no future, right? So what they're going to be doing, you're working at JP Morgan, that's when the M&A team comes knocking and says, hey, you got all this cash, you got no future drugs, let's talk to you about who you should be buying right now. All right, and that's when you can even predict this is a company, you're going to see an M&A announcement with them in the next 6 to 12 months because they don't have a choice. They got nothing in the pipeline. They got a lot of cash, but their 3 drugs are in a lot of trouble, and that's all they got. They don't really have a lot of this stuff that's going to be potential blockbuster. So I'm just telling you, this is the level of insight that you need to have when you look at companies. Expectations are everything when we value companies because it's about understanding the future and the dynamics of the marketplace. Again, that's why I said you're going to hate me for Stock Track, but that's why you got to do Stock Track. And by the way, you want to win Stock Track? This is the type of stuff you got to look at because Stock Track is going to quickly teach you it's an expectation game. You want to win in 3 months. You don't look at long-term value. You look at changes in expectations in those 3 months. Play that. You win Stock Track, right? Point number 4, competitive advantage. Over time, and you're going to see some data, and I don't think I put it in this presentation yet, scrolling ahead, but what the data is going to tell you is all companies see their ROICs eventually equal their cost of capital, no matter who you are. You get 0 spreads over the long run. Competitive advantage does not last forever. Doesn't matter who you are. Even Apple. It's happening to them right now. All right? And here's how I know it's happening to them right now. You know what the next big thing is after smartphones? I'm convinced I've decided what the next market is. I saw it. I didn't go to CES, but I saw the news coming out of CES. What was the #1 buzz in technology at CES this year in January? Yeah. Alexa. What is Alexa? Do you have does anybody here have an Echo? They sold 8 million of these things just organically without really talking too much. They plug them on the Amazon site. But what is Alexa?
It's like a voice activated, like,
Yeah, it's machine learning, artificial intelligence. It's basically just voice activated command and controls. So instead of asking Siri that says, you know, I don't know, what's the temperature going to be like Wednesday? The sky is blue. Like that's Siri. You know, Siri sucks. Well, it's a good idea. Just Apple is not implementing it well because Apple's a hardware company and the people that are implementing this well are Google and increasingly Amazon. It's Amazon Web Services and they're one of the most technically sophisticated companies in the world. And that's what Jeff Bezos is creating. And I'm just telling you, they are winning. And here's how I know. Because at CES this year, every automaker said they're putting Alexa into the dashboard. Not Siri, not even Google. They're putting Alexa. And it's Amazon's voice recognition technology and all the AI analytics behind that stuff. They're also putting in all the smart home devices. Hey, Alexa, lock all my doors. Hey, Alexa, turn off all the lights. Hey, Alexa, change the temperature to this. That's what's increasingly happening. That's the next big thing. Apple's not participating in that marketplace at all. They're way behind, right? So they got the phones, but the hardware is becoming commoditized. And even the software is becoming commoditized because you can't tell the difference between the interface anymore of the iPhone and an Android phone. So increasingly, it's what the phones can do. And that's where Google and to some degree Amazon are pulling ahead. I'm not saying Apple's not doing well, but just like everybody else, you know they're not going to do well forever because that's what the data says. Nobody that's doing well 30 years ago is doing well today. Technology, who was it 30 years ago? It was IBM. Who was it 20 years ago? It was Wintel. It's Microsoft and Intel. All right? Then it was Dell. Now it's Apple. Very soon, it's to some degree Facebook, Amazon, Google. The world's going to change. So when we look at our competitive advantage for companies, what we have to have as a bias is nothing lasts forever. So we have to assume that things are eventually going to come down. So the question with our companies is the only way they get a positive spread is they got to have advantage. And even if they do, how long is it going to last? And one of the most common mistakes people make is they assume it lasts forever. Nothing lasts forever, no matter how good you are. All right? So I'll tip my cap and I'll say, great job, Apple. You've had an amazing run, but it can't last forever. Nothing can. And we as analysts have to look beyond the emotion side and be objective when we analyze these things. And so competitive advantage has gone from what Warren Buffett used to call the moat theory. And what Warren Buffett looks for in a company is starting to change. But nonetheless, what he said historically is I want a knight in my castle, ever expanding my lands. I want growth. And I want a moat around the castle to keep people out. I want my competitive advantage. And if I can find those two things, I win. Well, here's the problem. What if nobody wants to invade your castle anymore? Your moat doesn't matter. How many people in this room have a BlackBerry phone? Anybody? They have less than 1% worldwide market share, so a few people have them. But here's the thing. 10 years ago, they had 70% market share. I'm sure when you guys were in high school, you had BlackBerries. Did any of you have BlackBerries before? I know you're really young, so maybe not. But in 2007, they had 70% global market share for smartphones. Today, they don't exist anymore. They stopped making them. They actually abandoned the hardware. They sold it off. So here's the point. Nothing lasts forever. If I told you in 2007 BlackBerry was going to go away, you'd have laughed at me. It's what happened. I'm telling you in 2017, not that Apple's going to go away, but Apple's not going to be as dominant as it is in 10 years. It's just life. And so we have to understand how long is their run and how long will it last and can they reinvent themselves? So when I value Apple, I have to take that into consideration. All right. So competitive advantage, do you have it and how long will it last? So we're going to create a framework this semester that has some math in it. And what's behind the math is actually summarized on this PowerPoint slide. This is what all the math, which McKinsey calls the key value drivers that you have to understand to value a company and understand how they're positioned now and how it changes over time. At a high level, it's three things. Spread, demonstrating your return on invested capital and cost of capital, or IRR and R over time. 2, growth. But here's what you need to know about growth. Growth doesn't create value. Say that one again. Growth doesn't create value. If you could borrow at 9% and make 3%, is that good? If I borrow at 9, I invest and I make 3. Is that good? No. Should I do more of that? That'd be pretty dumb, right? Growth is an accelerant to value. If I borrow at 9 and I make 3 and I do more of that, I become less valuable. If I borrow at 9 and I make 13, well, guess what? Crunch all you want, we'll make more. I will become ever more valuable. Growth is the accelerant. It's like stepping on the accelerator. When we have bad growth, I want to step on the brakes. And we have to differentiate between the good and the bad growth companies out there, right? Because there are a lot of companies that are just trying to grow, and they have no chance of actually making a good return. And they think that that growth will be highly valuable. And we have to discern this, because Tesla is actually a good growth company, even though right now they have terrible NPV. They have terrible performance right now, but the market's assuming that they're going to be dominant and have competitive advantage in electric cars in the next few years, and they're betting on that future. And so they're giving them credit now for that. But if Tesla doesn't actually achieve it and go deliver on it, their stock price could fall really far, really fast. And that's what we have to understand as a risk factor if we're trying to communicate that to a client of Tesla as well, as to what's driving their stock price. Is there's a belief that not only will they hit this volume, but they'll have a competitive advantage about everybody else out there trying to do electric cars. Matter of fact, if you want to talk about autos, here's something extraordinarily, in my opinion, disruptive, because it actually made me turn my head. Cadillac. Has anybody seen Cadillac's subscription pricing model that they just launched? Launched this month. Anybody seen this? Look for this. I think they're going to probably do ads for it around the Super Bowl. For $1,500 a month, flat. You can have any Cadillac you want. And they have a white glove concierge service that if you want to switch it out, call them the next day, they drive it out to you, take your old one away, and you drive the new one. You can change your car up to 18 times a year. You have any Cadillac you want for as long as you want. We cover all the mileage, so you don't have to worry about mileage. We cover all the insurance. We call all the maintenance repairs. So no oil change or anything else. No tires, all included. $1,500 a month, any Cadillac you want. So guess what? It's about to snow. Send me an Escalade, high-end Escalade. You know what? It's not snowing. I'm getting ready to go to the beach. Send me a convertible. Or send me that 600 horsepower one that seems crazy and is just going to get you tickets because you want to go have fun. But nonetheless, switch as much as you want up to 18 times a year, $1,500 a month, all in. And it's monthly. You don't want it? Cut it off. Or to take it, you're done. No long-term commitments. It's not a lease. I actually, like, that's not a bad deal. Like, I have a high-end German car. And my high-end German car, when you start putting in all the other costs associated with the insurance of, a couple $100 a month for insurance, plus lease payment, plus everything else, plus it's a lease, there's no flexibility. I was like, damn, I wish BMW and Mercedes would do something like this. I'd sign up for a second. But I even thinking, like, if I was actually in the market for a car, I might even consider the Cadillac option. It's not so bad. Now, here's the thing. This is the trial. You know what's going to happen in 3 years? It's going to go to everybody else. This is when they talked about applying the different models, business models, to car manufacturers. And that's the point. You're not going through dealers with this. Cadillac's going directly to you. You're dealing with the manufacturer. And one of the ways they're really making money is they're cutting out the dealers, right? Because they're actually getting the wholesale cost of the car that they're then putting out to you at $1,500 a month. And essentially, they can flex their demand. And essentially, I'm just saying, it's interesting how it changes. So when we think about sustainability, even Cadillac, which hasn't been doing so well, has actually gotten better cars. And now, in a way, they're being aggressive, like T-Mobile. They're disrupting the industry. And we've got to think about what the impacts of the other automobile companies are. So nonetheless, these are the types of things that we have to understand when we start looking at companies and understanding what's going on. This is the high-level 3 key value drivers. Sub-drivers of ROIC, 2 drivers. 1, profitability. 2, productivity. So to understand what's going to change our ROIC over time, we have to think about those 2 sub-drivers. Right? So for example, I just wrote an article about this coming out in March. But the idea is that Nordstrom and Walmart actually have similar ROICs. Right? They get there in different ways. Right? Walmart is a low-margin company, but they're very productive and efficient, and they turn their product really fast. Nordstrom is very expensive, great customer service. You pay a high margin for it, but they don't sell nearly as many products as fast. But when you annualize it, they actually end up in a similar place. So 2 drivers of return, margin, productivity. So that's the other thing we're going to dig a little deeper to understand how they change over time and how it will impact the returns, which will impact the cash flows, which will impact the values. And cost of capital, which is another word for risk. We have to think about risks in the business for the companies. So it's a quantitative class. It's also a qualitative class because the numbers are pretty easy. If you made it this far in your college career, you can do the math. The math in this class is algebra, right? And it's rearranging equations. But at the end of the day, it's just algebra. This is not calculus. Math's not that hard. And you got to know what the math is and when to use it. The math's not that hard. Hardest part, how'd you come up with a number? Right? Why'd you use this growth rate versus that growth rate? Why'd you use this margin versus that margin? How'd you figure out that break even? Like, what assumptions did you use? And so that's what I'm going to try and teach you how to do. Critical thinking. Because that's the valuable skill. That's the differentiator, right? And that's what this class is about. So it's going to be a lot of work. There will be an assignment every week between now and the end of the semester. So that will be the cadence of the class. And it'll be a lot of self-paced learning and individual. And you'll be using the Bloomberg tool every week between now and the end of the semester. And it'll be a couple exams and there'll be some group projects. So it'll be a lot of work. I know some of you might be second semester seniors. I'm just giving you a heads up. I had a couple people that are on the hold file that would love to get in the class. If this isn't your cup of tea, you're still in the drop ed period, I won't begrudge you, right? But nonetheless, once you get in it, I'm just gonna say, unfortunately, there's a lot of work involved in this class, but a lot of opportunity to learn some things. So that's where we are. Any questions? All right, so here's what I'd recommend. try and get an account before you leave. If you don't have one, it takes a couple minutes just to start the process. On Monday, we'll talk more about the certification. Try and acquire, if you haven't already, the textbook. Do a little bit of the reading. We'll continue on lecture note 1, talk about the Bloomberg certification, and go from there. Okay? Have a great weekend. Welcome to the class. I will take what we just did today, save it, post on YouTube. The link will be available through ELMS. I just want to. I want to save the recording before you add to the recording.
Okay.
So this is, what is today? January 25th.